Hi everyone, thanks for tuning into my channel, All Things Accounting. Today we are going to be dealing with closing entries, what they are and when they're performed. So stick right there and we'll get through this together. Closing entries are usually performed at the end of the accounting period when financial statements are prepared. So for the net income or loss, that's usually reflected in the owner's equity account. So revenue and expenses have to be closed out to what we call an income summary, and withdrawals are closed out to the equity account. So we'll go through all this together. But before that, there's a couple of definitions that I'd like to go through so that we can get a better understanding of all this. First of all, we want to go through what are called temporary accounts, or they're sometimes not called nominal accounts. So these accumulate data for an accounting period. So these include such accounts as revenues, expenses, withdrawal, and these are the only accounts that are closed out on a monthly basis if you're doing monthly closing. The other ones are called permanent or real accounts. So these report on transactions. I'm going to designate transactions with a TX to one or more accounting periods. And it could be future, we'll say a future, one or more future accounting periods. So these never close. These at the end of the period the balances will get carried over to the next period. So for example, assets, liabilities, and owner's equity accounts are not closed. Okay, so income statement accounts, they're always for the period of, whereas permanent accounts, balance sheet accounts for assets, liabilities, and equity, they're as at. They're a snapshot of the financial position of the company at a certain point in time. Usually, most companies have it at December 31st, a calendar year end. So that's why they would prepare the balance sheet as at December 31st, whatever year. Whereas for the nominal accounts for the income statement, it would be for the period of, covering for usually for the year. So there are a certain number of steps that we're going to have to perform in order to close our accounts out properly. So step one would be to close our revenue accounts to income summary. Step two would be to close our expense accounts to the income summary. Step three would be to close our income summary to statement of owner's equity. And then lastly, step four would be to close our withdrawals account to owner's equity. So an example here, let's say for example ABC Company. All right, so this is for ABC Company. Let's say for example for revenue, strictly speaking about revenue, there's consulting revenue that they have. And this is consulting revenue. And they have rental revenue as well. So this is rental revenue. So let's say that because we know that revenues normally have a credit balance. So let's, for example, say that ABC company has consulting revenue balance of 5,850, and they have a balance of 300 for rental revenue. At the end of the accounting period, we need to close both of these out to the income summary. So what we do was that we make a journal entry to nullify both accounts. So in this case, it would be debit consulting revenue for 5,850. We would debit rental revenue for 300. And we would credit income summary for the sum of those two, which comes out to 6,150. So the net effect of this is that you're debiting that for 300, you're debiting this for 5,850. So the effect is that it's zero now. This account is zero. Now step 2, let's say for example for ABC company that we have a series of expenses. So let's say that we have an amortization expense account there. And let's say that we know that it has $200 in there. Salaries expense is going to be approximately $1470. We know that we have another account for interest expense, and that's going to have a debit balance of $35. We know that there's an insurance expense with a debit balance of about $100. There's another for rent expense, and that one has $1,000 debit in there. And supplies expense, that one has a debit of $1,050. And lastly, let's say that there's a utilities expense, and that one has a debit of $230. So in order to close all of these out to the income summary, we need an equally offsetting journal entry to close every single one of them out. So we're going to have to credit this one for $200, credit that one for $1,470, credit that one for $35, credit that one for $1,050, credit that one for $230, credit that one for rent expense for $1,000, and credit insurance expense for $100. So the net effect of this is that we are debiting income summary for the summation of all of those, and that would equal to $4,085, and we would credit amortization expense, credit salaries expense, credit interest expense, credit insurance, credit rent, credit supplies, and lastly, credit utilities. So, in this case, amortization 200, salaries 1470, interest at 35, insurance of 100, rent of 1,000, supplies of 1,050, and lastly, utilities of $230. So let's take a look at the effect of the income summary. So let's say we have a look at the T account for income summary. Now we know that we had closed the revenue account out, and that had an aggregate of 6,150 for revenues from the consulting revenue and the rental revenue as well. We knew that the summation of all the expense accounts totaled to 4,085. So the net effect of this is that there's still a credit of 2,065 credit balance on the income summary. So what we need to do is we need to close, as part of step 3, close the income summary out to owner's equity. So this means that if there's a credit balance, we need to offset that with an equal debit balance of 2,065. So debit, we would debit income summary of 2,065, and we would credit statement of owner's equity or capital in whatever the name would be of 2,065. Now, remember, step 4 is then to close out the withdrawal account. Let's say, for example, withdrawal for there's a balance of $600. So we would need to make an equal and offsetting income journal entry to offset that, to close that out. So we would need to debit the the statement of owner's equity. So it would be capital 600 and credit the withdrawal of 600. So let's look at the impact on statement of owner's equity or the capital account. Let's say, for example, we had a balance carried over from prior accounting periods of $10,000. We know that there was a net credit that was closed out from the income summary because revenues were higher than expenses. So here it would be 2,065, and then we know that the capital was reduced by withdrawal because we closed it out with an offsetting credit of $600. So the net effect of all this is that there's still a credit balance of 11,465 in the capital account. So I hope that you find that this tutorial was useful, and if you liked it, please subscribe to my channel and please hit that bell notification icon so that you're always up to date on the new tutorials that I'll be posting on various topics, and please click that like button. So until next time, take care.